This might be the most disconnected market ever. Horrible data. Look at that unemployment number. But the market is grinded higher. We're going to explain why and what the next move is. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links. Have several articles, videos that I have added today. Also, if you're looking for a different opinion, that of Wall Street and big TV, please do consider subscribing. Today's agenda, as always, we're going to start with the big charts. Look at those charts, see if we have an idea where we're heading. We're going to go to what keeps me up at night, look at that underlying data, and then our game plan going forward to prepare you. Let's go to the big charts. All right, first up, let's start with the monthly chart as always. As you can see here, right, we're kind of right at that line. Momentum still negative. We are going to call that negative as well. Here's your weekly, trying to come around here. Talked about this last time. Not there. Most importantly, at the 61% retracement on Fibonacci, link up here for new subscribers, we have failed, and that puts me in a negative view. Going to go quick here. That 61% is key. Okay, why? Let's go back to 29.33. We come down, we fail at the 61%. 72.75, look right there. 61%, same thing. The new era, I say that because of technology, right? 98.02, right? We're up, we're kind of banging around. You come down, fail at the 61, and also have your death cross right there. And then the great financial crisis. Here you go, twice you went above it and then failed, tried again here and then went down. So that shows you history real quick, and let me show you today and what I see. Same thing. All right, there's your death cross, 50-day moving average going over 200. So we came up, and I said this a while ago, I wouldn't be surprised if we hit 61. I was looking at the 50 last week, but we got up, we failed, and then as of today, I'm recording this about 9 o'clock on Friday morning, we got about a negative 2% based on some big tech earnings. What else do I see? Short term, this is relative strength, okay? I have that on a 5-day relative strength, okay? And that shows when you go above, you are overbought, okay? A couple other things real quick. When the market was going down, volume was surging. When the market went up, look at volume going down until the last couple days as we go into the end of the month. Okay, so what else do I see here? We've got the VIX, Volatility Index, okay? That's based on the future, okay? We're at 34 in the VIX. Remember, above 30, uninvestable, hit 31, and went back up, okay? That is another big sign for me. Now, on MACD, momentum on this side. Convergence, divergence, right? You have a 12 and 26 day. To keep it simple, black above red, positive. That's when the market went up. But as you see, as the market went up, look at the momentum going down, which would make sense because volume was going down. So this is what kept me paused within this and why I've continued to be negative. Had we moved above the 61, I may have made a different decision, or the 200-day and added equities, but we did not. Next up, Sector Spotlight. All right, got a lot going on today, so we got to keep it going. First up, gold, all over the place, but I like this. We call that a bullish flag, okay? I'm not quite at my full position here, but ready to do so. Volatility's going down. I do like gold going forward. Next up, consumer staples. Why? everybody's buying consumer staples right now, right? Supply and demand in that case. So we did have a little bit of a death cross here, but here's what I like. When it went back up, look at the momentum on this, right? It was getting stronger, stronger, stronger. That is a good sign. Still holding above 50 on relative strength. So I do like consumer staples. How about healthcare? You would think this would be a good place. I've been hesitant, okay, because now, same thing. You see healthcare going up, but look over here, momentum is going down. So that's not a good sign. That has put me on pause, but I am buying some individual names in the healthcare space. Okay, 10-year treasury. Why do we put that and the dollar together? Okay, because they are telling a different story of the stock market. Okay, and I always say the bond market's smaller. You can see what happens here, right? We've gone straight down, had a little move to the upside. Now, we actually quickly moved out of treasuries, just cut our position, going into Fed meeting, anticipating them to say they're going to slow down repo. They did that. So we've had a little move up, okay? And then treasuries this morning, bought back in. Treasuries this morning are looking to go actually down, right? Yields down, price up. So we like that. Dollar hasn't done much, okay? But it is still there. The dollar, there's a shortage of the dollar internationally. I like the dollar going forward. We are at max position on that one. So that's why we talk about the dollar. Let's go to what keeps me up at night. All right, lots of energy, moving quick today. Sorry. Cycles. If you're new, we talk about the cycles. Keep in mind, we're not a buy and hold type group here, okay? I look at the cycles to help make our investment decisions. Now, growth slowing. Inflation decelerates. Hello, commodities, right? The Fed wants to see inflation. We're getting big time deflation right now, especially with what's happening and the markets are going down. We anticipate a deep move into cycle 4. If things get better, we then go to cycle 3, where inflation goes up. And based on what we're seeing, that has a potential to be hyperinflation. So what keeps me up at night? Look at this unemployment, right? 30 million people. This is just devastating. So when you see these numbers and see the market goes up, that is the disconnect. Consumer represents 70% of GDP. So next up, what I really look for when it comes to unemployment is continuous claims. Okay, now it's a lagger, so we're showing 18 million right now. We want to continue to watch that. Now there's talk about going to 20, 30% employment. Maybe we hold continuous at 10% by year end, to be determined, but this is the number one concern right now for everybody. This is what really is just ugly, but I want to put things in perspective. We have lost 23 years of job growth in 1 month. That is a tremendously ugly situation. Now I talk about CNBC, I joke because those knuckleheads, what's his name? Josh Brown and Jim Cramer. So the other day, Dow jumps 500 points on positive notes, right? Don't worry about what's down here, everyone. Well, that talks about GDP having a huge downside number at 4.8%. So let's look at those numbers, right? There's the minus 4.8% number, okay, which is actually minus 7.68% in total, okay? Now, when you look at this, to put things in perspective, right now, Q2, we're anticipating a 30% drop. Since 1945, the worst we've ever had is 10%. We're looking at a 30% drop, okay? Getting a minus 6%. I mean, this is atrocious. This is that disconnect again. This is reality, and the stock market has been unrealistic, right? Next up, the Fed, driving me crazy, right? Kind of a joke here with Powell. Our $17 trillion debt and $1 trillion yearly budget from Donald Trump in 2012 is a national security. 17 trillion. It's 23 today, to put things in perspective yet again. And that doesn't include the federal debt. So what's different this time? Well, one, if you go back to this crisis over here in 2000, 2002, interest rates are at 6%. They had a lot of ammunition, okay? We're at 5.5% in the great financial crisis, and they slowly funded the market while lowering rates, right? And that was the liquidity that you've heard about so many times. This time, they're trying to front run it. I don't think it's going to work. It worked for a month, but we're now at $6.7 trillion. That is a disgrace. It is not good at all. It concerns the heck out of me. So what really concerns me is debt to GDP. Now, I can only go back to 66 in this chart, but think about World War II, right? GDP soared, as you can imagine, to fund the war, but they paid it back down. This book I'm reading right now called Aftermath, Jim Rickards, fascinating book. I'll have Andrew put an image on the screen and also a link below on where you can get it, okay? Now, what he talks about is above 60 is really dangerous. Now, we're at about 105, 108 right now, with the anticipation going to 120. That is frightening, okay? We can't continue to pile on this debt. It is not good for the country or the economy. Let's now take all this information, talk about our game plan going forward. All right, so next up, what's our game plan? What are we doing? What are we thinking about? Always get the question, when will this end? So let's look at a couple things here. The average recession is 20 months long. I do think, and a lot of other smart people feel, this is going to be a 2 to 3 year. We're not even looking at, forget about what's happened last month in the stock market. You're talking about 30 million people unemployed. How many of those are not coming back with all these new rules coming about? Think about restaurants, only 50% capacity. Not meaning 50% of people are going to show up. They're going to have to cut all their chairs, okay? So you look at that. The other big thing is GDP, all right? Now, in the great financial crisis, peak to trough was minus 5.1%, okay? That was in the great financial crisis. Guess what, folks? You saw it in that last chart. We're looking at a -7 number. So much worse than last time. We're looking at -30. Look at, I'm not saying that's going to be the same situation, 29, 32, 37, 42, but the average is 4.5, and we're going to be worse than that when it comes to GDP, okay? What's your number? Okay, we're not buying hold here, folks. You got to be nimble, right? What are you comfortable with, right? Most clients say 7 to 10%, but go back to when we were down 30%. What was your portfolio? Did that make you happy, uncomfortable? We came back. We have an idea that's going to go the other direction. So find opportunity, upside or downside. Like I said, if we had gone above 61% retracement, 200-day moving average, despite all the bad data, I would have gone back in the market. Look at the volatility index. Again, we did not break through 30. I heard the guy on CNBC the other day said, 30's the new 15. No, it's not. It's such a stupid statement. Follow us for updates. Okay, Facebook. I'm on all the platforms. Facebook's the best because I'm allowed to communicate there from a compliance standpoint. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.